Good morning and welcome to the Ben Garves Podcast, a daily show dedicated to the idea that fitness is for everyone. My name is Ben Garves and I am your host. One of the cool things about branching out from the old WODDITY Podcast is that I get to help you with things that go above and beyond our old CrossFit focus. One of those topics is financial security. In March, we watched one of the biggest market roller coasters in the history of our modern financial infrastructure, followed by an almost immediate surge to a 30% national unemployment rate. Swings like that affect real people and real jobs. But despite a third of Americans being out of work, a complete halt of tourism with the closure of hotels, resorts, and restaurants, and a near total grounding of global air travel, the stock markets have recovered and a number of stocks are knocking on record high values. So wait, is the economy bad or is the economy good? Well, let's start by saying the stock market isn't necessarily a direct indicator of how good the economy is. It represents a demand for ownership or stock of some of the largest companies in the world. Those companies can have business models and products that are quarantine proof. Take Amazon, Walmart, Target, UPS, and FedEx, for example. Quarantine has only increased demand for online shopping and product delivery services. On the other hand, a company like Disney lost over $5 billion in projected revenue because their income depends significantly on their network of theme parks and on box office turnouts for their films, both being activities people have taken a step back from. Then you have a company like Tesla, which has seen its stock jump from $300 per share to over $1,400 per share. All the while, nobody is actually buying cars. You could argue Tesla was undervalued at $300, or that it's such a new and exciting business prospect that investors are spending money on it despite the fact that there is a lack of demand for their products. Either way, we know that with a 30% unemployment rate, we're likely to see 30% decrease in goods made and services rendered, and also a 30% decrease in demand for those products, and therefore a potential 30% drop in total value of business conducted in the United States. Which companies are impacted where and how deeply then becomes an educated guessing game. We know the healthcare industry is in high demand right now. We know fast food and eat-in restaurants are struggling while meal delivery services are booming. But what we cannot see directly represented in the stock market is the struggle of the estimated 30 million small businesses operating in the United States today. Those businesses don't get the same visibility but drive a significant chunk of our economy. Any personal finance guru will tell you should be saving money for a rainy day. This is the time to start if you haven't already started preparing. Thanks for listening this morning. Please be sure to rate, review, subscribe, and share. It's free to you and it means the world to me. My name is Ben Garves and we will chat tomorrow.